I'm indifferent about the dollar. It's you look at the versus the Dixie, which is mostly Europe. You look at the trade weighted broad dollar. It's basically in the middle of the range it's been in for the last 5 years. And as Anna mentioned, there's a good reason, I guess, for it to pull back a little bit. But the key thing to remember about the dollar against a broad measure of currencies, it only goes down after it goes up a lot, and it went up a lot into the massive Federal Reserve and fiscal stimulus and monetary stimulus we had into that peak in 2021. Now it's coming back. I don't know how much lower it goes, but in terms of, I do enjoy when people equate it directly to Bitcoin. It's a small factor. And I think the actual price of Bitcoin now in the gold and copper, it's a much more significant factor, much more established commodities that are basically the inversion of the dollar.
The U.S. Federal Reserve will raise its benchmark overnight interest rate by 25 basis points to the 5.25%, range on July 26, according to all 106 economists polled by Reuters, with the majority still saying that will be the last increase of the current tightening cycle. A resilient economy and historically low unemployment well over a year since the Fed began one of its most aggressive rate hiking campaigns in history has repeatedly confounded analysts and investors. Inflation is falling with the headline Consumer Price Index (CPI) measure slowing to 3% in June from 4% in May. That led many observers on Wall Street to conclude inflation might soon be tamed, prompting some to renew bets that rate cuts could happen by as soon as the end of 2023. The current debate is whether more rate increases might be needed to ensure disinflation continues or if doing more could cause unnecessary damage to the economy. We would now join Mike McGlone as he shares his views and outlook on rate hikes, inflation, and other economical signals. As we get into the video, make sure to hit the like button, subscribe, and drop your comments.
Market expectations. You look at the WIRP function on the Bloomberg terminal, it says 92% that they're going to raise another hike on July 26th, and they're going to keep raising, and we're not going to get a cut until March. Now, this is what a lot of economists think, but it doesn't matter so much when the market's already priced for it. So I look at it, it's still simply a fact is the market, the Fed is still taking away liquidity, and most risk assets are expensive, completely expecting this soft landing, and the whole narrative is termed that, oh, we're not going to get a recession, the Fed's still tightening, everything's okay. I look at this as one of the most offside markets in history, and the risk reward is just not good. And so if my scenario kicks in, which I still think it's going to, with we'll let Anna comment on this, you get the normal reciprocity from all this tightening, and it shows up in the economy, but in a delayed reaction. Bitcoin should want to be the first ones to show it. So right now the Fed is still going to keep tightening, and what's going to keep them tightening is the stock market keeps going up. It's still that same issue, which is a problem. Then I look over at Bitcoin is, yes, I'd love to be bullish Bitcoin, but if you look at that price right now at 30,000, the first time it traded 30,000 was right at the end of 2020, right at the beginning of 2021. And if you look, so it's unchanged. You look at the NASDAQ over the same period, it's up 20%, yet the volatility of NASDAQ is half that of Bitcoin. So right now, yeah, Bitcoin's great. It's got all this ETF coming on. We have the hopium for the ETF, but if the actual performance versus the NASDAQ, which has got AI and everything going for it, I look at it as I'm disappointed. And I think it's still the problem is I sense so much bullishness, but yet the macro is very unfavorable. The Fed is still taking away the punch bowl. Because I had to bring up some charts and things I've been focusing on for a while. And that's, first of all, let's start with U.S. new homes under construction. It's the highest ever. I go back to 1969 on this one, and the chart looks just like it did in 2006-7. It double topped and then collapsed. The big difference was back then as the Fed started easing in September 2007. Big difference, and also we have this massive spike in interest rates. Yes, we're freezing up the sell side for people who do not want to sell their home and refinance at a higher rate. But since when is seizing up a market good for it? And another chart it made me bring up is we just look at producer price index is the year-over-year measure. It's at -3%. It's only happened 3 times in history since 1949. This is the finished goods measure, and it's never happened with the Fed funds rate still rising at, I'm just using a 3-month bill at 5.28% at the moment. This has never happened before. And I look at it as, okay, maybe the whole rules of all the lessons of economics and liquidity and cycles are no longer accurate, which is what I've been doing on my vacation. I've been really enjoying reading and relearning all this financial history stuff I forget on a daily basis. Those are accidents just waiting to happen. Now, PPI at 3% is probably bottoming soon. But the fact that the Fed is still tightening the environment, now we see China, every single piece of data out of China is disappointment. That's a train wreck just getting started. So I look at this as this is the macro. I'm an impatient person, and the market's testing my impatience. But these things take a while. Let's look at the facts. They started dropping the required reserve rate about a decade ago. It's been dropping ever since. They've been pumping liquidity forever. Now we have a housing crisis that's kicking in and unemployment. And on a nose, we hear from my colleagues who are based there, they have to be careful because this is the situation now is you can't put your name into an article on China if you don't want to risk imprisonment. And that's just the way that's the fact. So we're at that stage now. It looks to me, China to me is a combination of peak Japan and peak Soviet Union about 3 decades ago. It's all tilting that way. Quick question I ask is, what changes this current trajectory of disappointment? They have to stimulate, yet they know they can't stimulate much anymore. Locals, I hear the local entities are so over indebted, they have issues. And of course, the housing crisis looks like it's just getting started.
McGlone also shares his views regarding the crypto space, stating that even though he is long-term bullish on Bitcoin, he thinks it's too early to make predictions of the price as there are so many uncertainties in the market as it stands. He also talks about the Hong Kong crypto dollar and general outlook of the stock market, bonds, and equities. Let us now get back into the video and hear what he has to say.
Everybody said, I think we can all put together. I definitely agree with Dave about the optionality of Bitcoin and digital gold. And remember, I made the call for 100,000 Bitcoin when it was trading below 20, and we got that in Ethereum. And then, of course, what happened with China. And I still stick with that in the long term, but I think it's more likely to drop 50% and get down to 20, even make a new low before it goes on that trajectory, particularly when I see things like, well, I can get 5.25 in a T-bill, done. I look at the Case-Shiller index, the housing index, it just was almost at the highest ever right before, like 2006, up 20%. Now it's down 1%. That's collapsing. I look at the Fed still tightening. And the last thing that always usually falls is the stock market. Just look at your history. I remember 2006 and 7 was tough, just like Big Short. I was short a lot of stuff and I didn't get paid back until 2008. It's just the way it works and people get stopped up. But there's two things. One thing I want to mention is what's happening with Case-Shiller. Bitcoin, I completely agree, but it has major competition like gold does from the U.S., the base currency giving you the best rate on the planet and the deepest treasury market. But there's one thing I also want to mention I really enjoyed recently to point out how significant this technology is. We're hearing about Hong Kong maybe lightening up a little bit of their strict regulations, and I heard they might approve a Hong Kong crypto dollar. The Hong Kong dollar is pegged to the U.S. dollar, which means that's a quasi crypto dollar.
Dollar stable coin. So is the Chinese yuan, right?
But
so is the digital yuan.
Exactly. It shows how significant this technology has adapted to the U.S. system, to the dollar, organically. And it's for the U.S. not to mess it up. And I think the updated Lummis Gillibrand bill is going to show that they're not going to mess it up. But it just shows that you can't overweight them. So I just double checked. I always love to check the volume. I show this to everyone. If you check on coinmarketcap.com and click on volume, Tether's always number one. You love it or hate it, but I've seen that since 2018 in Hong Kong. They pointed it out to me. You will see the stock market drop 50% and stay down and not make a high for 10, 20 years. It always happens, and always happens after the biggest pumps in liquidity, which we've had. It could take a new high, but I love hearing traders have traded for 10 years. I've been trading for 10 years. Like, you need to trade for 30 years. And this is Dave. I knew Dave would laugh because we've seen this before, and I've seen it. It's the narrative I've seen. It's usually the psychology. When you hear people, when people tell you, oh, well, when you just express something rational and optimistic about how markets work, and they say things like, well, feel great being poor. And then you look at yourself. I remember hearing that in the 80s, in 87. I remember hearing it in 2000. I remember hearing it in 2006. And the key thing I'm really worried about now, and with this, is there's so much bullishness, even from Larry Fink, who has a vested interest in pushing a product to track Bitcoin right now, that I have to push back and say, good luck with that one. T-bills look great. And yes, we've seen this before.
The view that rates will stay higher for longer appears to be gaining traction, with a share of respondents polled during the July 13 to 18 period who predicted at least one rate cut by the end of March next year, down sharply to 55% from 78% last month. For the Fed, despite the soft CPI print, we still anticipate a hike in July. And while we hope the softness in inflation persists, it is unwise from a policymaking standpoint to bank on that, said Jan Navruzi, U.S. rates strategist at NatWest Markets. We do not want to rush ahead and say the fight against inflation has been won, as we have seen head fakes in the past. Economists and financial market traders appear to still be slightly out of step with the Fed. The latest dot plot projections from members of the central bank's policy-setting Federal Open Market Committee suggest the benchmark overnight interest rate will peak at 5.5% to 5.75%, but only 19 of 106 economists polled by Reuters forecast it will reach that range. Expectations the Fed is nearing the end of its hiking cycle have pushed the dollar to its lowest level in more than a year against major currencies. A weaker greenback is likely to make imports costlier and keep price pressures elevated. Indeed, economists are still concerned that inflation might not come down quickly enough. Core inflation, which strips out food and energy prices, will be only slightly lower or remain around the current level of just under 5% by the end of the year, 20 of 29 respondents to an additional question in the poll said. The Fed targets inflation as measured by the Personal Consumption Expenditures Index, PCE, for its 2% target. Core PCE was last reported at 3.8% for May. But none of the inflation gauges polled by Reuters, CPI, Core CPI, PCE, and Core PCE were expected to reach 2% until 2025 at the earliest. While the latest figures are encouraging, the real battle begins now as the easy base effects are now behind us, said Doug Porter, chief economist at BMO Capital Markets, referring to the fact inflation plunged so much in June partly because it was so elevated at the same time last year. As the disinflationary force of lower energy prices fades, that will leave us dealing with the underlying 4% trend in core. And to truly crack core will likely require a more significant slowing in the economy. The strong labor market is only expected to loosen slightly, nudging up the unemployment rate to 4% from the current 3.6% by the end of 2023, the poll showed. A slight majority of economists who answered an additional question, 14 of 23, said wage inflation would be the most sticky component of core inflation. Nearly two-thirds of respondents to a separate question, 27 of 41, expected a U.S. recession within the next year, with 85% of them saying it would start at some point in 2023. Still, the economy was expected to grow 1.5% this year, up from the 1.2% predicted a month ago, and then slow to 0.7% next year. What are your predictions for the economy by the end of the year? Let us know in the comment section below. Also, don't forget to always hit the like button, subscribe, and make sure to turn on notifications. Thanks for watching.